Channel and welcome to the channel and welcome back to another video, guys. All right, so on today's video, today's live, guys, as you come in, let me know that you can hear me. Give me a thumbs up if my audio checks out okay, and we'll take it from there. Today we're going to be talking about index fund investing for beginners. All right, the ultimate investing strategy. Guys, give me a thumbs up if you can hear me. Just doing a quick mic check. Yes, you can retire a millionaire with index funds. Okay, so this is kind of an index fund investing video for beginners. Okay, people that want to, get rich, build money, build wealth, be investing in the stock market, but do it on a more passive level. So as you guys come in, just give me a thumbs up that you can hear me. And I really would appreciate it, guys, that you can hear me okay. Appreciate it. All right. So index fund investing for beginners. Okay. The ultimate index funds, in my opinion, I'll just tell you my opinion up front. Index funds are the ultimate investment. They really are. So thank you guys for joining us. We can jump right into the video. Today we want to talk specifically, as I said, about the ultimate investing strategy that is index fund investing. And we want to sort of introduce index funds for some folks that may be beginners, and I'll explain why I believe that index funds are the ultimate investing strategy down the road, guys. Thanks for the thumbs up. I appreciate it. Some questions we want to answer on this live is, what are index funds? How do they work? What are the different types of index funds that are out there? Because in my opinion, most of us are going to do much better if we invest in index funds and if we invest in the single stocks, right? So again, we'll give you a little bit of history. We'll talk about the pros and cons. We'll talk about some risk that are involved, because with every investment, there's risk, right? Index funds, as nice and as safe as they feel, there's still some risk involved there. So index funds are no exception to risk. And I want to just give you my opinion on why I believe these are the ultimate and the best investment that's out there for most of us. Guys, as you come into the broadcast, do me a favor, let me know where you at, what city, what state, what country, what continent are you on, right? Just let me know that in the chat section. I like to kind of read the chat as we go along, guys, here and there. So please let me know where you're coming from, and give me a one in the chat if you do invest in index funds. Give me a zero in the chat if you don't invest in index funds and you just want to kind of learn a little bit about them before you jump into them. Just let me know that. Looks like we got Florida in the house. Good to have you, Fletch. Certain from Canada. Good to have you here. Is SCHD good? Absolutely. We'll rap about that one. That's a Schwab fund. And Hucklebuck is checking in from Atlanta. Appreciate you being here. Kenny from Chicago, West Side, South Side, North Side. Let me know. And it looks like Elsa does invest in index funds. A one if you invest in them, a zero if you don't. Terry Sims, good from Atlanta. Good to have you. Fletch, not yet, but hopefully after this video you will. Terry Darwin, zero. We got someone from Detroit, and we got DC here. So we got several people here, Red Tablet Talk and David West, that don't invest in index funds or haven't invested in index funds. We got a few folks that do or have. So we got a nice cross section of people. We got some new people that aren't in index funds, right? I think index funds are like one of the secrets to the stock market, that regular average people really need to know about, right? And right now they don't. So got Reggie checking in. Good to have you, Reggie, from KC, Kansas City. We got Jackson, Mississippi here as well. The great state of Mississippi, East Texas here, Columbia, South Carolina, Nigeria is all the way here. So we appreciate you being here, guys. As you come in, smash that like button for me, right? Just tap it real quick and we can get going here, right? Share this video link. If you're viewing this on replay or something like that, feel free to drop a comment as well. And let me know your thoughts on index funds if you're watching this on replay, and whether or not you invest in them, guys. First of all, let's just jump right into it. Whether you are new or experienced, you need to know about index funds. Maybe you're new to the market, the stock market, and you're new to investing. I'm going to take these off. New to investing, you still need to know about index funds, okay, and ETFs, exchange traded funds. because that's going to make you a better investor, right? The more you kind of expose yourself to in terms of knowing a little bit about, you ain't got to be an expert in any of this stuff, but just knowing a little bit about these things is going to make you a better, more informed investor, right? So, what is an index fund? Let's jump into it. What is an index fund and how do index funds work? Okay. An index fund is first of all, an index fund is a type of mutual fund. Okay. An index fund is a type of mutual fund or a type of ETF, right? We'll talk about the ETFs in a little bit, but index funds is basically a bucket of stocks, right? That come from a specific sector or a specific segment or a specific group that you choose. Now, you don't choose the stocks that go in the bucket, right? You choose the whole bucket, right? And so an index fund is a bucket. A mutual fund is a bucket. Again, index funds is a type of mutual fund, right? So that bucket that you buy an index fund, you're buying the whole bucket of stocks. An index fund is a bucket of stocks that come from a specific segment, a specific sector, a specific group of stocks that are thrown into the bucket. It might have 70 stocks in the bucket. It might have 700 stocks in the bucket. But an index fund is just you buying that bucket that includes a whole bunch of stocks. Okay. So that's important to note. That's kind of what an index fund is, right? For example, the best example that everybody's heard of is the S&P 500, right? The 500 top companies that make up comprise of 3 or 4 thousand different stocks, or however many there is. Could be 5,000, right? But it changes a little bit here and there. But the S&P 500 is an index, right? Because that's a group, a bucket of stocks. That's 500. There's actually a little more than 500 in the S. They just call it the S&P 500. But that's an index fund. You might have heard the Russell 2000, right? Or the Wilshire 5000, right? Those are all indexes because they are buckets, right? So those are kind of some common ones. You got Nasdaq, right? You got the Dow Jones, right? The 30 top. You got the 30 of them. You got Dow Jones. Those are buckets. And so those are index funds, right? So those are just some examples of what an index fund is. There's all different types of index funds, though. So an index is just a grouping of stocks, right? And you can't invest directly into an index, but you invest into an index fund. Kind of the wording there, right? A market index measures the performance of that basket, or that I call it a bucket. Some people call it a basket, right? I call it a bucket, right? So it could be stocks, it could be a bucket of bonds, it could be a bucket, right? It could be, an index of a lot of different types, right? A lot of different sectors of the economy, right? But just keep in mind, index fund is just a bucket of individual stocks thrown into a bucket, okay? And typically that bucket is going to track something in the market, right? The difference, one big key to know about index funds is that there's no fund manager, right? There's no one that's taking and putting stocks in and taking stocks out of the bucket. Now, a traditional mutual fund does have a fund manager, and it's said to be actively managed. So a regular mutual fund is actively managed, and it has a fund manager or managers who pick the stocks to go in the bucket. So they put stocks in, they take stocks out all the time, right? Call that like a turnover rate, right? But those are actively managed funds. Regular mutual funds are actively managed because they got a guy or a lady who is actually actively managing the bucket, right? Index funds don't have to have a fund manager actively managing the fund because it's just following a group of stocks, right? So because of that, right, index funds being passively managed, um, regular mutual funds being actively managed, which one tells you there's going to be a higher fee? There's going to be a higher fee on the actively managed regular mutual funds because that fee is going to pay for the management, right? It's going to pay the salaries and things like that, however the salaries come, right? But index funds, because they're passively managed, meaning you can kind of hands off, Don't have to have anybody managing it. The funds are low, or the fees are lower, right? Because there's no one that you have to pay, because it's just following a group of stocks and how they do in the market, right? And they're in that bucket, of course. So so for example, as I mentioned, the S&P 500, that index, that S&P 500, whatever the bucket will be, we call that bucket of index funds. It's going to buy shares of stock in all the companies that make up what's in that bucket. For the S&P, for example, S&P is buying shares of stock of all of the companies that make up the S&P, if we're using that example, right? So that index, they call it an index because it's simply going to mirror the performance of all of the stocks that are in that bucket, right? If let's say we're using the S&P, for example, if the S&P goes up 1%, then the index fund that's following the S&P is going to go up 1%, right? If the S&P goes down, we're using S&P as an example of an index fund. If the S&P goes down 1%, then the index goes down 1%, because the index is just simply following the market and what the market does. Again, it's a passive way to invest in the stock market. Everybody doesn't want to sit around and have 6 monitors in front of them and watch ticker symbols all day, right? We just don't have time to do that, right? So, a little bit of background. January 1960, there was an issue, and I think I'll pull it up real quick. Let me take a look at it. It's called the Financial Analyst Journal. Two guys, Edward Renshaw and Paul Feldstein, published an article entitled "The Case for an Unmanaged Investment Company." That was one of the first times that an unmanaged investment company idea really hit the market. Now, don't get me wrong. The guy that started Vanguard, his name was Jack Bogle, right? He came along in the 1970s, and he opened up the first company that was going to actually introduce index funds on a broad scale basis, right? So, but Jack Bogle actually, I think in 1950, he had a thesis, and Jack Bogle, I got a book here. If you don't read anything else, check that book out. Common Sense Investing, right? Jack Bogle. So anyway, he did a thesis for his I think his graduate school in 1950. He wrote a thesis about it. 10 years later, these guys wrote an article about it. But it wasn't until the early 1970s that Jack Bogle actually opened Vanguard, right? The concept of Vanguard. I think Jack Bogle had been working for Wellington Funds or something like that for 20 years after he got out of college. And it wasn't until the early 70s that he said, okay, let me just take this idea more broad scale, right? And he ran with the idea in the early 1970s, and a lot of folks called him crazy, right? But he's the founder of the company that you all have heard of called Vanguard, and he introduced the Vanguard VFINX, right? That was the first index mutual fund, right? That was in August of 1976, right? When they launched that first fund. But the idea had been floating around for 15, 20 years, 30 years before that. Right. But he was the actual person that said, let's start a company around the whole concept of of index funds, right? It wasn't a lot of hoopla, fanfare, and things like that, right? And it wasn't really cool back then to say, I own index funds, right? Because that wasn't a thing back then, right? So the whole point of it, though, was to take out the managers, right? Because what you see in some of the larger companies, guys, or what you saw back then was you saw that managers were making all these fees, and that was eating up a lot of people's profits. Anytime there's a fee, the fee is going to eat into your profits. That's how these companies make money on products other than index funds that have larger fees, right? How they make money and pay their employees and pay all the administrative costs and all that good stuff is it comes from returns and the fees that they charge for those returns. So as a investor, you got to understand that, right? If you can cut out the manager, pay less fees, you'll have larger returns, especially over a long stretch of time, right? So back then in the 70s, many people that were in academics, many people that were in the stock market investors and fee and fund managers and all that, they thought the idea of promoting something like Vanguard would they didn't like it. Right? There was so I don't want to go too deep into that, but it wasn't. Some people called it back then un-American. If you read some of the literature from back then, called it un-American to have this type of company that didn't include fund managers, right? But lo and behold, Vanguard survived. This is the 70s and 80s, and come the 90s, index fund investing got much more popular, right? But the ultimate attraction to index funds then and now is that you don't need these fund managers who charge fees, and over the long period of time that really eats into your profits, right? I could show you chart after chart. I'm not going to bust out any charts, I don't think, but it's very important that you understand fees and fee structures, but understand also that the index fund typically has much lower fees. That's one of the big reasons why they're attractive. We'll go over some more pros and cons, right? But that's why Vanguard today, guys, Vanguard today is seen as one of it's I think it's number 2 or 3 in America in terms of holdings, right? But they're one of the best brokerages because they've been around for a long time and they introduced the whole concept of index funds, right? So let's talk about some cons, some problems, some issues, because like I said earlier, every single type of index fund or every different type of investment that you make, no matter what it is, real estate, stock market, you name it, there's always going to be some risk involved, right? There's always going to be some cons. So I do want to talk about the cons, right? So if you invest in an index fund, you got to keep in mind that you cannot outperform the market because, again, the index is just mirroring the market, right? It's just mirroring. So you can't, if you're one of these people that you want to outperform the market and one of these Warren Buffett types where you think you can go in and beat the market, study after study after study after study shows that most people, most fund managers aren't beating the market. Matter of fact, 60, 70% of mutual funds, they only they lead, they're not around 20, 30, 40 years, right? A lot of them fold, right? But the thing about index funds is you can't outperform the market. So you're stuck performing as high or as low as the bucket of funds performs, right? Again, it's passively managed. So there's no fund manager picking stocks to go in the bucket. You're stuck with the funds that are in there. If they dip, they dip. They go up, they go up, right? So that's another con, really. It's a lack of flexibility, right? You cannot toss out stocks that are in your index fund. You can't do that. Okay, if stocks underperform in an index fund, you're stuck with them, right? You got to stay there with them. You don't have that flexibility, right? So that's kind of a con, right? For a lot of people. A lot of people want to be able to, dibble and dabble and throw in, throw out. But the other con that leads to another con is that there's no floor on the losses that you have, right? In other words, when a stock goes down and down and down, and it's in the bucket of your bucket of stocks in an index fund, and the stock is going down and down and down, it's you can't do anything about it. There's no fund manager to bail out the fund. Now, the beauty of the fund, and we'll talk about some of the cons, but the beauty of that is you do have some diversification because you got 100 stocks in there, right? But during down markets, typically, and I'll say this, and you can do the research on this, but in down markets, when the stock market's down, funds that are actively managed, mutual funds that are actively managed, do a little bit better than index funds in down markets. Because again, an index fund, you're stuck with the stock that's there. But if you have an active fund manager, you can rip out a stock or two or three or four that's not doing well, replace it with another, right? So in a lot of ways, in a down market, actively managed funds typically do a little bit better. But that's the kicker. And this is well, I'll get to that in a little bit. So the other thing I want to tell you this about a con is that If you're the type of person that wants control over managing, actively managing your own portfolio and all that good stuff, you can have that type of control, but you only have it to the extent that you're managing a bucket of stocks if you're managing index funds, right? But some people really enjoy the idea of having their own um, set of 20 or 30 stocks that they can pull from and buy and sell, and they just enjoy that activity, and that's cool too. Now, me personally, I don't enjoy all that. I like passively managed funds. That's why I like index funds so much. But you can't really pull and add and all that with an index fund. You're stuck with the funds that are there. Um, so the other thing to think about, and I always want to mention this when it comes to index funds, is that the size of some index funds can sort of dilute their performance. Okay, and we know their performance is helped by the fact that they're passively managed and they pay less fees. We know that, but still, whenever you're investing and you spread your stuff around to, let's say if it's an index fund that has 1,000 or 700 different stocks involved in the bucket of your index fund, the more you spread it around, the more you have a potential to dilute your performance, right? So the real highs kind of go away when you're talking about index funds that are broad based, right? And the real highs kind of go away because you have so many stocks in that bucket that, yeah, some of them are doing super duper well, some of them may not be doing well, but they kind of balance each other out. And if they're kind of balancing each other out, guess what happens? You don't get a whole lot of highs, right? You get kind of this right here, less volatility. And you may be saying that's good, right? But keep in mind that you're spread out and you're diverse because you have so many stocks in your bucket of index fund that you're kind of losing a little bit of the high performance that you may get. So, and again, the more diversified you are, the less risk you have. And the less risk you have, the less possibility of those really high highs, right? So just keep that in mind when you're talking about index funds, right? So you don't have the possibility of these real high highs or the possibility of these real low lows, right? So index funds, guys, let me just say this. Index funds are considered typically more of a long-term investment, right? Not for short-term gains. That type of thing is not really an index fund thing, right? Index funds are typically for long-term investment, right? So that's some of the cons, right? Whenever you're talking about an investment vehicle, don't just get all happy and hyped up over the pros. Remember, there is some cons too. Anytime you invest in anything, guys. All right, good to have you here, guys. Look like we got a few folks checking in. Angie's here quite a bit. Good to have you, Andy. Good to see you, Angie. Angie, good to see you again. Angie Madcat. Um, Fantastic. All right, now let's jump into some of the pros. I've talked about a few of them, but I want to make sure I'm detailed with them. Why would you ever want to buy an index fund, and why they are better? In my opinion, they're the ultimate investing tool, ultimate investment. Why would you want to buy an index fund as opposed to individual stocks? The first thing is this, guys. You can be hands off with index funds. Okay. Again, passively managed, not only there's no manager that's managing what goes in the bucket, right? But also passively managed by you. You don't have to be sitting there watching the ticker symbols and all that good stuff, guys. Look, typically, the stock market does what over the long period of time, over a 5 or 10 year stretch? What happens to the stock market in America? The stock market goes up, right? Typically, right? There's some chinks in the armor where it goes down, down, up, but typically it ends up. Here's the secret. The stock market is tracking American businesses, point blank. When you take away all the fluff and all the fancy words and the acronyms and all that, the stock market is tracking American businesses, right? Guess what's happened to American businesses over the last 15, 20, 30, 50, 80, 100 years? It's gone up, right? Guess what's probably going to happen to American business if you get out of the TV and all the naysaying? What's going to happen to American business in the next 10 years? It's probably going to go up. If it doesn't go up, we're all in trouble, right? So it's probably going to go up. So guess what? All you really got to do is chill out, be patient, relax, and just flow with the market going up. And the best way to do that is a passive index fund, right? Hands off. You don't have to do all this, all that. I don't want to spoil anybody's I don't want to spoil anybody's parade or anything like that, right? But all that trading and all this, that's cool, but it you ain't got to do all that, right? You really don't have to do all that when it comes to stock market investing. You just get you an index fund or two or three and just chill. Watch it rise over the course of 5, 10, 15 years. Again, long term, right? So hands off for you, passive investing. It's also great for newbies, right? New people, people who don't care to do all the researching, right? Listen, you buy an index fund that has 100 stocks in it. You ain't got to be sitting, you ain't got to go over and look at all the 10Ks and the quarterly reports and the annual reports from all these different companies. You really don't have to do that type of research when you're talking about index funds, reading all of the information that's coming in, paying attention to exactly what every single company is doing, right? You really don't have to do that, right? Most of us are busy. We got busy things going on, lifestyles, right? If that's you and you don't want to sit there and track individual stocks, research individual companies, learn how to read not a perspectives, but learn how to read quarterly reports for all the firms, all you got to do is invest in an index fund that's tracking a sector of the market that you know, that you like, that you understand, tracking a sector of the market. That's all you got to do. That's why for most of us, 90% of us who don't want to sit there and watch ticker symbols all day, right? The index funds is advantageous. It's wonderful for most of us, right? Most of us don't care to keep up with the US economy to the extent that you have to be a super duper informed stock market investor, right? Most of us don't want to keep up with all the financial sectors that are out there. We just want to keep up with the financial sectors that we like, we know, we enjoy, we want to be invested in. That's it, right? So, and the other thing is, most people just aren't that good to pick winners, right? We think we are, right? We listen to a few things, read a couple 10Ks, all of a sudden we think we can go out there and pick a winner. No, people that have studied the stock market for 10, 20, 30, 50 years of their life aren't out there picking winners constantly. They lose to the general stock market as well. They don't beat the market. Most fund managers don't beat the market. What's that tell you about the market? It's unpredictable. So if you're trying to beat the market, you're taking more risk than if you just bought an index fund, right? So if you buy index funds, you don't have to worry about trying to beat the market, right? Most active fund managers underperform and don't beat the market, right? Now, you can Google that, you can read that, but once you understand that, for most of us, it wouldn't make sense to be paying them fees if they're underperforming the market. Why would we pay them fees if they ain't even beating the market when I could just cut them out and go invest in the market for much lower? When I say invest in the market, go invest in index funds for much lower fees, right? So and so the other another pro about index funds is the diversification, right? It lowers risk. And for a lot of us, we don't want to take the types of risk that we take when we invest in individual stocks or when we invest in things that are more speculative like Bitcoin or something like that, right? When we're investing in maybe commodities or other things, sometimes there's larger risk. When you talk about index funds, much lower risk. Diversification because you're investing in a bucket of stocks that has 100 different stocks in it, right? Or a bucket of stocks that has 3,000 stocks in it, right? So your risk is kind of balanced out, like I said before. And again, your portfolio, if you invest in a lot of index funds, your portfolio is going to experience a lot less volatility, a lot less this and more of this, right? And for most of us, we can stomach this a little bit better than we can stomach this, right? So again, and we talked about fees, guys. That's a huge pro. Index funds charge lower fees. We talked about that than the actively managed mutual funds. Fund managers, if okay, there is some fees involved in an index funds, right? But they're just tracking the underlying index, right? Which requires much less effort. You know, they're not much fewer trades, right, than attempted and then trying to attempt to beat the market and all that kind of stuff. So typically, and I just want to go over this real brief. Typically, actively managed funds like mutual funds, their fees can be like 0.5% to about 0.75%. I don't want to get too heavy into ratios or PEs and all that good stuff because this is more of a beginner video, right? But traditional mutual funds with fees of around 0.5% to say like 0.75%. Sometimes they can get as high as 1% and 2%, right? Uh, usually 1.5, over 1.25 or 1.5 is usually considered a high fee, right? This means, okay, so for example, a 1% fee means that if the value of your investment is $1,000, you're going to pay about 15 bucks, right? Over the course of annual, right? If it's $10,000 invested, you pay 150. Now, that doesn't sound like a lot of money. Well, 1%, 1.5% sounds like nothing. But if you compound that fee over the course of 20 years with a lot of money, fees can eat up, or fees will eat up your returns, right? Fees eat into your return as the investor. Okay, fees don't eat into the profits that a fund company makes, or the fund manager. It's not. It's eating into your profits. So that's why fees are very important. Index funds typically aren't going to be as high. Those fees aren't going to be 0.5% or point, 0.75%, 0.75%. Index funds are going to be carrying fees more like 0.2%, right? 0.08%, 0.04%. So the index fund fees are much lower typically. Sometimes they're not, but for the most part, they're lower than mutual fund fees, right? Right. So again, I don't want to dig too deep into expense ratios and all that, right? But and we'll talk about that on probably another video. But the whole premise you got to know, the one of the biggest pros to index funds is low fees. Okay. Now, what types of index funds are out there? Let's see here. Boom, boom, boom. All right, cool. Guys, let me don't before I forget, make sure you smash the like button, okay? Hit the like button. We're gonna get into some types of fees real quick. But hit the like button for me. Share the link to the video if you can, guys. I really would appreciate it. Um, and so, yeah. Somebody said I sound like their favorite investor, Warren Buffett. Yeah, we'll talk. I'll talk a little bit about Buffett here in a little bit after I go over the types of funds, types of index funds, because Warren Buffett, for as much as Berkshire Hathaway does, he's a huge proponent of index funds, right? For most people, he's a huge proponent of it. But anyway, what types of index funds are out there? All right, what types? Because these buckets, I gave you an example earlier talking about the S&P 500 or the Wilshire or the Russell. Those are types because those are buckets, right? But there's all different types of index funds, right? There's what they call broad market index funds, right? Which tracks usually large segments of the market. S&P 500 is kind of a broad market, but there's more than three or four, five. Somebody help me out. 3, 4, 5,000 different stocks. You could track the entire stock market as well, right? So, for example, I think with Vanguard they have like VTI. I think it's VTI. What is it? Let me see. I think it's VTI. Yeah, VTI is an index or ETF that tracks the entire stock market. So that could be your bucket, the entire stock market. That could be your index fund, right? So there's VTI is out there. There's tons of others, guys. I got a bunch of them. I'm going to be doing, just so you guys know, we've got some. If you join this channel, right? If you join this channel, it's like $2.99 or $6.99, different levels. But if you join per month, if you join this channel, we're going to be digging into more of what my portfolio looks like, trying to help you guys out. I'm mostly a Vanguard person. Okay, so VTSAX and VOO and VGQ, VGT, all those things are things that I invest in. Okay, but if you join that, we're going to be doing some lives where we're talking more one on one and talking about what I invest in. So you can tap the join button if you like. But anyway, so you got these broad market index funds that are tracking a large segment of the stock market, right? I think Schwab, you guys can let me know if you're a Schwab person. I think Schwab has SCH. um, SCHB, maybe something like that if you're Schwab. Um, Vanguard has a total bond market where you can track the entire bond market, right? So there's a lot of exposure when it comes to different index funds, right? It's not just S&P. That's only one. There's hundreds of different types of index funds that you could be in. There's index funds are also separated by the cap, right? The market cap. There's market cap index funds that invest specific based on specific market capitalization ranges, right? So small caps, you can have a small cap index fund. You can have a medium cap. You can invest only in large cap index funds. Large cap is usually where their capitalization is over 10 billion or so. Um, Cap meaning capitalization. Each individual stock has capitalization, guys, right? That's the current share price of the stock multiplied by how many number of outstanding shares there are, right? So big companies, Apples and Alphabets, Google and Meta and those type of companies, Tesla, right? They're considered large cap, you know, large cap because their capitalization is over 10 billion, meaning that the current share price times the total number of outstanding shares is over 10 billion. But you have some small cap too out there, right? So just keep that in mind there, guys. There's different ways you can do that. Small, mid, large cap. You can also invest in index funds through sectors, like I said earlier, right? Based on, sector-based index funds may be a good fit for your portfolio, right? These are index funds that can be great for expressing your own investment opinion. For example, over at Vanguard, they have a um, they have a socially conscious index fund, right? That's only investing in companies. It has 70 or 80 companies that are socially conscious, right? That have diversity on their board and all this kind of stuff. So, I mean, different places where you buy index funds may have different types of index funds, right? Um, so you don't have to go digging through. You can find, hey, what is the technology sector? Maybe there's a technology index fund. Maybe there's a fund that's focused on financial companies or healthcare companies. Maybe there's an index fund that's focused and concentrating on the top 100 communication companies around the country or utilities or energy. You get what I'm saying, right? So there's different types of index funds that you could figure out what sector you want to be investing in, right? And so just keep that in mind. And there's targeted index funds. There's also important to note equal weighted index funds. For example, if you invest in the S&P 500 and I want to have that as my index fund, the S&P 500, I'm going to track that as my index fund. You can do that, and that's fine. I think on Vanguard, it's called VOO, right? But if you do that, that's the ticker symbol VOO. But if you do that, you have to remember that when you buy that index fund, Apple may be weighted 10% of that index fund, right? Microsoft might be 6% of the index fund, right? So those are unequal weighting. But if you want, you can invest in index funds that are called equal weighted index funds that removes this market cap weighted index that typically occurs in some of the larger broad-based funds, right? So you could do that if you want, where all the companies in there have an equal weight, right? All the 100 companies or 500 companies have an equal weight. So there's a lot of different ways to structure what you want to do when it comes to investing in index funds. Again, you don't have to just buy the broad index funds that you always hear about, right? You can get exposure to many different sectors through different types of index funds. That's why some people say, "Hey, should I only buy one index fund?" You can if you want, but if you also want to have a little bit of exposure to healthcare, a little bit of exposure to the companies in the Nasdaq, a little bit of exposure to energy companies, then you might want to diversify your portfolio into several different types of index funds, right? Also, keep in mind this: you can always invest a portion of your money in stocks, individual, and a portion of your money in index funds, and a portion of your money in ETFs, and a portion of your money in mutual funds, right? You're not stuck, right? You can use index funds as a piece of your portfolio. They don't have to be your entire portfolio, right? You may want to have the bulk of your money in 90% of your money in index funds, but then you might want to have 10% of your money and play with individual stocks a little bit, right? Right. Also keep in mind the overlap. Sometimes when you invest in more than one in the index fund, there's an overlap. Okay. Because the 100 funds, 30 of the 100 funds that are in this index fund might also be in the other index fund you want to invest in. So keep that in mind also. Speaking of overlap, let me show you guys a few websites real quick that are pretty interesting. I think you guys need to know these. All right. One of them, I'll just pull them up on my computer if you guys are okay with that. But one of them is let's see. Let's just go right here to ETF Research Center. ETFs. I'll talk about ETFs. ETFs are like index funds, right? But ETFs are a little bit different. I'll share that with you in a minute. But on your screen, guys, you might see ETF Research Analysis for serious investors. Okay. Now that website is a sweet website when you want to compare, maybe say like the overlap. It's ETFRC.com. If you're investing in index funds and you want to compare the overlap to see what overlap there is from fund to fund, maybe there's VOO and VTI at Vanguard, and you want to see is there overlap in those two. Well, you can go on this website and you can do that and check that. So I just wanted to get that out there to you. ETFRC.com. If you're a serious ETF or index fund investor, that's a good website to check out and be a part of. Another website, and I'll throw this one at you too, is well, I won't go there yet. I'll wait on that one. All right. So if you're trying to be the next Warren Buffett, index funds may not be for you. But if you're trying to take Warren Buffett's advice, index funds may be for you, right? Just keep that in mind. Warren Buffett, he gives a lot of great wisdom and perspective when it comes to investing. He writes, I think in his 2013 letter to his Berkshire investors, every year he does a letter and they do a press conference, him and Charlie Munger, right? He laid out what he thought was a great investing strategy back in 13. I think he did it again in 18. I'm not sure. But he talked about a simple portfolio that's going to outperform most portfolios. And he said, you don't have to pick winners. You just simply own a cross section of businesses and you'll be just fine. I think he gave a 2 fund portfolio, right? He said, have an index fund that tracks the S&P 500. Put 90% of your money in that S&P. 90-10. Did he do 90-10 or 80-20? And then he said, put 10% of your money in a short-term government bond index fund, right? That's it. That's what he said do, I think in 2013. But that's his advice to like regular people, regular investors like you and me, right? And I think that's what he told his I think that's the money that's going to be left to his heirs if he leaves any money to his heirs. It's going to be broken out like that: 90% S&P, 10% bond, both index funds, right? But he also said never sell when news is bad and stocks are low, right? You never want to sell like that, right? But he's just a regular average guy, but he's not really a regular average, right? He's picked some heck of winners over the years, but you know, his 90-10, some investors say, like for instance, Jack Bogle says, do a 60-40. 60% of your money in a broad-based index fund like the S&P, 40% of your money in a bond index fund, right? That's a government bond, right? Over the long haul, as we see in the last year or so, bonds have been up, right? Stocks have been down, bonds have been up. But if you're investing in the stock market, uh, you know, be careful about over exuberance, right? Be careful about over exuberance, right? Entering the stock market in times of, hypeness, right? And then getting nervous when things go bad, right? So just keep that in mind, guys. Um, so again, time is your friend, impulse is your enemy. Index funds. Time. Who said that? Was it Bogle or Buffett? Time is your friend, impulse is your enemy. Impulse is jumping in and out. Index funds, they don't make, they're not good for jumping in and out, right? They're a long-term investment. And of course, with index funds, the beauty I like of index fund is you pay less attention to all these swings in the market, right? You don't have to worry about it. You just buy it and you hold it. I'm a buy and hold person when it comes to the stock market, when it comes to real estate, right? Buy and hold, right? You don't lose money if you don't sell it, right? Well, now, are index funds popular? Let me actually answer that question because I got this question the other day. Ago. How popular are index funds? Index funds are very popular. One of the most common forms of investing is index funds. And I think it's really one of the most easiest to understand. And it's really, I think, especially with ETFs, because they typically have no minimum investment, right? I think it's one of the low hanging fruit that most of us new investors or folks that haven't invested very long, you can easily get into the market and you can understand it with index funds, right? Um, so, how do you invest in index funds? Let's rep about that real quick. You have to figure out which brokerage you want to go for. Now, guys, do me a favor in the comments. What brokerage firm are you guys at? Anybody? Robinhood, Webull? Are you guys Vanguard? Are you guys Fidelity? Are you Schwab? Are you BlackRock? Are you name it Chase? What? Let me know if you guys are TD Ameritrade or Merrill. Is Merrill still around? They were bought out by Bank of America. But what do you guys invest in terms of where you invest? What platform do you find the most easiest and user friendly? Right? For me, it's Vanguard. Right? I'm a Vanguard person. But for some of you, like some of you, let's see here, Stash. Some folks go on Stash. It looks like. John is on Fidelity. Fidelity and Schwab, said Brandy. Schwab, Fidelity, and M1 Finance. And somebody said Stash, Tony. Yeah. So we got some folks in different. Now I'm a Vanguard person. I like their platform, but you have to choose. If you're new to index fund investing and you don't know much about them, you need to go on, just do a simple search on you on a Google, and you can do it on YouTube too, but on Google, and just look around and read around and see which platform that you like the best, right? That makes sense to you and you understand it's sort of easy to understand. You think about that. Then look up some of your pros and cons. I mean, if you're on Vanguard for index funds, you can't do fractional. Fractional. You can't buy and some like VTSAX, the total market index fund on Vanguard. It requires Admiral shares, so it has a minimum of $3,000 that you can invest right and to get into that one. Some places don't have as many minimum or have minimums like that, right? So it depends. You have to choose what's best for you. Let's say we got Schwab in the house for Benjamin. Pete O like Schwab also. Schwab must be pretty popular. We got Fidelity. Kenny is in Fidelity. T. Rowe Price for 401k. We got some Fidelity. We got Schwab. Nobody's in Vanguard. Looks like I'm the only one that's a Vanguard person. But I like Vanguard a lot. Been there for a long time and enjoy it. So you have to choose that. That's one of the things that you have to do. And there's some pros, there's some cons. Now I don't do a lot of the Webull or a lot of the ones that are on your apps. I don't do a lot of apps, right? But for some people, Stash and Acorns, or if Acorns are still out there, Robinhood and so forth are still out there. Stockpile, I think was one. But anyway, the other thing you got to consider if you want to invest in index funds is, again, how many you should own, whether you want the overlap that's out there. And you need to know what the overlap is because you don't want to be thinking you got three different index funds, but you got the total market at Schwab and you got the total market at Vanguard and you got the total market at Fidelity. There's not much diversity there, right? So just be careful about that, right? It depends on how diversified the stocks inside the index fund are. You need to know. Don't just buy an index fund. Know what's inside the bucket, right? Know what those individual stocks are, right? You may only need one or two index funds, but you may want to have exposure to several different sectors and have being like three or four or five or 10, right? So just keep that in mind. There's also targeted. We didn't talk about targeted index funds as well. There's different types of those as well. ETFs, let's talk about that real quick. ETFs are exchange traded funds that can be traded very similar to index funds, but they can be traded on the market like stocks, okay, throughout the day. So index like stock prices go up and down throughout the day, ETF prices go up and down throughout the day, and you can trade them like stocks, right? So ETFs are considered a little more liquid. Now, index funds a little bit different than ETFs, right? Index ETFs are baskets as well, but index funds, it can only be bought and sold only for the set price at the end of the trading day. So big difference between ETFs. You can't really trade index funds like that, but you can trade ETFs. So, and then there's some tax implications and all that good stuff too. Again, the big key, one of the big keys, and there's a lot to go into here, guys, and we spent 50 minutes going into some of the basics of index funds. But you always want to check your management fees and management expenses, right? What they call expense ratios. You want to check those. The lower, the better for you, right? And then you also want to figure out, okay, what index do I want to track, right? Do you want to track the index that follows the entire stock market, the S&P 500? Do you want to have one that tracks bonds? Do you want to have an index fund that tracks international companies for international exposure, right? When we say exposure, we're just talking about, you understand what exposure is. You want to track small companies, large companies. These are things that you need to figure out if you want to invest in index funds. So keep that in mind, guys. Unlike 401ks, I think I saw somebody mention something in here. Index funds don't have any contribution limits or withdrawal restrictions or anything like that. I think I saw a question or a comment about that earlier. And I'm just looking back here. Again, guys, this is an introduction to what I believe is, in terms of index fund investing, is the ultimate investing tool, the best investing tool, right? So, and again, keep in mind, in future videos, we're going to be talking about how to analyze index funds, right? And go into a little more detail about that. There is a few things you want to check in terms of, I mentioned expense ratios, but there's a few other things you want to check when you're looking at an index fund, right? Somebody said Schwab. Let's see, Stash is perfect for beginners, and they do fractional shares. Okay, good. Um, so fractional shares. Somebody said SR4 said fractional shares is why I left TD Ameritrade and moved to Fidelity. Yeah, everybody likes Fidelity for that reason. Fidelity, you can do fractional shares. That just means, guys, for people that don't understand what that means, it means if you don't have 300 or let's say $400 to buy Nvidia, you can buy a piece of a share. You can take $200 and buy half a share of Nvidia, right? That's all fractional shares pretty much is, guys. You can buy a piece of a share, right? You can buy a one-fourth of a share. You don't have to buy the whole thing at once, okay? So let's see here. Schwab bought TD Ameritrade. Okay. Maybe that's what happened. They're always buying each other. Everyone I've talked to love Vanguard. I do. Vanguard is really, really simple. Okay, it's the interface on Vanguard. When I say interface, I mean how it looks on the screen. It's just very, very plain. And I like plain because plain is good. It's sort of like what I'm using here, guys. Big shout out to StreamYard. StreamYard is if you're doing lives like this, guys, StreamYard is probably the most a third grader could understand StreamYard. I think StreamYard is probably the most easiest platform I've ever used on the internet. It's very, very basic and it's very simple to use. I mean, when you look at the platform right now, I'm looking at it, guys, because I'm looking at your chats in here. I mean, StreamYard is like, I got off task there when I talked about StreamYard. I'm sorry, guys, but Vanguard is like StreamYard. It's almost like a fourth grader could understand it. It's very, very simple, and I like that. So that's why one of the reasons I'm attracted to Vanguard. Um, so let's see here. I'm just reading some of your chats here, guys. Stockpile charges a lot of fees. Yeah, let me say that. I don't want to throw anybody on the bus, but I had some stocks over at Stockpile that somebody gifted to me. And when I got ready to get rid of that and move it over to another to Vanguard, I had to pay like a large fee at Stockpile just to close out Stockpile. So you guys got to keep that in mind. Read the fine print when you're doing some of the Weebles and some of the Acorns and Robin Hoods. When you want to close that thing out, they might charge you a hefty fee. I know when I left Stockpile, I didn't have but a few $100s in there, but when I left Stockpile, I'm like 30% of the money had to leave because I had to pay them to close it. So that was kind of weird. Benjamin said TD Ameritrade was bought out by Schwab. Okay, I think so. Um, Somebody said, I know what an overlap is. I just like to invest in different ETFs. Yeah, different ETFs is pretty cool, right? No matter if they're overlap. I'm strange in the views, right? Yeah, but you just gotta be careful. Just know what overlaps. Let me show you guys a few of these websites real quick. Let me jump out of this one real quick and just show you a few of these other ones that you want to go to if you're really serious about ETFs and index funds and learning more about it. Let's see here. Let me just go to one of them right here. Um, Let's see, we went to that one. ETF.com. I'm not sure if you guys have been there or not, but ETF.com is a pretty nice one as well. If you're trying to learn a little bit more about these things, guys, ETF.com is a nice one. Has lots of articles, lots of potential for you to read, understand, and learn, etc. So I really like to go to ETF.com quite a bit. Another one I like to go to is where is it at? I'll show you in a second here. Let me show you this one while I'm here because I didn't show you this one. But have you guys ever been to something called Portfolio Visualizer? You might want to write that one down, guys. It's called Portfolio Visualizer. I'm going to walk through something real quick with you guys since we're all here, right? And we're all family at this point, right? So Portfolio Visualizer is a pretty neat one, right? And you might want to write it down. It's just portfoliovisualizer.com. And I'm going to see if I can't make myself a little smaller in the box if I'm a little bigger. Let me just get rid of me for a second. How about that? All right, so Portfolio Visualizer is pretty interesting. You can tap on this right here on the very first page of the website. You can tap on what's called Backtest Asset Allocation. Is it that one or is it the other one? It's this one. Backtest Portfolio Asset Allocation. For example, you can go through and fill out this information. It'll give you a lot of information, guys. You plug in your, we want to do a list view, your time period. Let's say year over year. Let's start in the year 2010. Let's say 2010 to today, 2023. And let's say you have an initial investment amount of, let's say, $50,000. Now, let's not say that high. Let's say $10,000. And you're talking about cash flows, you contribute a fixed amount. You can kind of change this around. You want to contribute, let's say, $500 monthly. If you start it with $10,000 in the market, I'm going to show you something. You start with $10,000 already in the market. Let's not even say 10,000. Let's say 1,000 in the market. You plug in $500 a month, rebalance it annually, and you want to have it in an asset class of, let's say, the total U.S. stock market. Total U.S. stock market, you want to have 100% of your money in the total U.S. stock market, and you're putting $500 a month in there. You start it with $1,000 in there. And let's see here. Benchmark. We don't want it. The benchmark will be just the, nope. Let's go here. U.S. stock market, 100%. You bought this index fund back in 2010 with $1,000. You put 500 a month into it. You come down here and click on Analyze Portfolio. It'll give you a breakdown of what you would have at this point, 13 years later, right? About $208,000 is what you'd have, and it goes through a bunch. I like this little deal. It shows you kind of how your portfolio has grown, but this is free, right? It's called portfoliovisualizer.com. It just shows you some interesting things. There's a bar graph of what your annual returns would have been. Guess what year that was? That was in 2022, right? When we had a real down year. I think S&P was down 18% in 2022. But it gives you how your portfolio would have performed up until this year, right? The annual returns. And it also shows you in a bar graph as well. Of course, this chunk right here was went down right there. That was the start of the pandemic right there, right? And so that's why it went down. But notice what happens to every single portfolio. This is the beauty of index funds. The beauty of index fund, if you had owned this index fund that tracked the entire stock market starting in 2010 with $1,000 and you put $500 a month in it, look what happens to your portfolio over the course of this time. It just does what? It just goes up. Yeah, there's a few chinks in the armor right here, a chink in the armor right here, a chink right here, a couple chinks right there. But for the most part, look where it is now and look where it was back then. Your portfolio just rises along with the market. That's the beauty of index fund investing, right? Up to a couple of 100,000. Now we adjust that for inflation; it's down to 146. But just notice you got 200,000 bucks in the market 13 years later, and all you didn't do anything. With this example I just gave and showed you right here, you didn't do anything. You just invested in the U.S. total stock market with an index fund that tracked the entire market, and you still got gains. You didn't have a fund manager or anybody trying to time the market and jump in and jump out. You didn't pay a whole bunch of fees to some fund manager or two or three that are sitting up in Washington, D.C. somewhere, right? You just bought an index fund, tracked the market, and look what happened to your money. It went up. And it did that because that's what index funds do. You didn't watch ticker symbols all day and have 3 or 4 or 5 monitors sitting in front of you. You weren't stressing out over the lows in the market. You didn't get stressed right here, and you didn't get stressed right here. You didn't really stress out right here. You didn't have a fit right here because you just put it in an index fund. And the index fund just tracked the total stock market. That's why you want to be in index funds right there, right? That's why you want to be in index funds. Okay. So, I mean, I just want to show you a few of those different websites, guys, that you might look into if you're interested in index funds, right? So, make sure that there's things to think about in terms of index fund. I hope you guys got the pros and cons because there are some cons, guys. I don't want you to think it's all good and gravy. Hey, thanks so much. Let's say Fat Boy Fitness for the $5 super chat. I really appreciate it. Thank you so much for dropping that on me. I appreciate that more than you know. Someone said ETF seems better on capital gains. Yeah, I'm not a big tax guy, so there are some different tax implications. Remember, ETFs are going to be traded, so there might be some different tax implications from ETFs to index funds to think about, right? Let's see. Fractional shares pop up when dividends are auto reinvested. Awesome. Hucklebuck says, is there a charge to transfer stocks from ESOL to my Fidelity brokerage account? Perhaps. You need to read the fine print and do a good search on that. Perhaps there is. I can't say for sure. E-Trade is one. Okay, I hadn't heard E-Trade before. Thanks, John. Good to have you here. So yeah, we just if you're late here, guys, do me a favor, rewind this thing back. We went over a lot of things in terms of index funds, the pros, the cons, a little bit of history, the different types of index funds. I even showed you guys a few websites to be looking at, what you need to be thinking about in terms of what to look for when you're buying your when you're buying your index funds. We didn't go too much into detail about specifically how to evaluate funds. We'll do that on a later live guy, later video. But we talked about a little bit about Warren Buffett as well. So what I wanted to do on this video was just give you guys, like I said, an introduction to what they are, right? They're nothing to be scared of. They're probably index funds are probably the easiest way for the average investor, which most of us are, me included, to actually win in the stock market over the long term, not the short term, not the day trading, not the trying to, the price of this went up by $2. Let me trade my 3 shares. I don't really have time for that. And 99% of the people I know don't have time for that. They don't have the patience for that. And we definitely don't have the stomach to stomach the ups and lows, the highs and downs of what you get on a every single day individual stock trading or individual stock purchasing, what it takes to do that, right? That when you do that, it evokes fear, it evokes panic, it evokes that's a human emotion. But when you're talking about stock market investing, the more you can get that out of your life, that type of up and down emotion, the better you'll be. And the beauty of index funds is that it gets rid of that because it's passive. Passive, not only that you don't need a manager to manage the funds, but passive that you can have sort of hands off. So hey guys, I just wanted to break that down to you guys. Don't forget in the description box below, please get your 24 Laws of Money free ebook from me to you, right? Talking about the 24 laws or principles of money that helped me build my wealth over the last 23 years I've been doing this thing. Now, there might be somebody in here that might be a federal government employee. If you're a federal government employee and you invest in the thrift savings plan that the federal government has, that's essentially just like index funds, just so you know, because they have an S fund, a C fund, an I fund, a F fund, a G fund. Those are basically just like index funds, just like the buckets of index funds. So keep that in mind too. I think I might have saw something about that in the chat or not. I'm not sure, but if that's you, just understand that that's it's almost the same as an index fund, right? It's the same point. Let's see. Let me run through a few more questions, and I'm going to wrap it up. So much educate. Thanks, Tony. I appreciate it, man. Seminole 2014. That's okay. Rewind this thing. Check it out. Smash the like button for me. All right. Whatever you do, Tap that like button. Really important for me, guys. That gets this thing out to more and more people. This basic information, when we first came in here, I said put a one if you invest in index fund, put a zero. There was a lot of zeros. There's a lot of people. I shudder to think there's a lot of people that don't invest in index funds because they don't fully understand them. But if you fully understand index fund, you'll know it's the best. It's the easiest. It's the simple. It's the way to still make money in the stock market without all the headaches and hassles, right? Um, yeah, okay, yeah. Pito says some homework. Absolutely, man. Check out those websites I gave you guys. Let's see. So much education. Good. Uh, that's all right. I believe fear is called the chicken market. Somebody said, yeah. Vanguard index funds have matching ETFs that have no minimum investment amount. Yes, that's why ETFs at Vanguard are so smooth. Yeah, you got some index funds at Vanguard that have a $3,000 minimum. Used to have a $5,000 or $10,000 minimum, but you have ETFs all over Vanguard that have no minimum, right? And when I say no minimum, I mean your VOOs, your VTIs, your VYMs, all those have no minimum, right? So keep that in mind. So somebody said, let's see here. That's a TSP. I have a TSP due to being part of the National Guard, but since didn't know much about it. Well, the TSP, you can't really invest in your TSP unless you're a government worker, but that money is still sitting there, right? But a TSP is just like the things that are inside the TSP is just like index funds, same concept. So here's the deal, guys. I'm gonna wrap it up. I certainly appreciate you guys being here. I want to thank you guys for being a part of this live. I want to thank you for being here. I appreciate you guys more than you know. Hey, this channel has grown tremendously. I mean, incredibly in the last 3, 4, 5 months. So, and I have you guys to thank for it. So we always have new videos coming out. We talk money management, we talk money mindset, we talk the basics of organizing and growing your money, making more money in terms of income, increasing your income. We also talk the US economy a little bit, what happens in terms of the Fed and what they do with the Fed funds rate, because that's important for us to know. But we also are digging more into the stock market and understanding the stock market, because I believe everybody should be investing somehow in the growth of businesses in America, because you want to experience that growth that happens to these businesses in America. In that on that chart I just showed you, you want to be you want to be a part of that. The best way to be a part of that is to be in the stock market, right? And I think index funds is the way to go, especially for people that are looking for real passive ways to still grow income, right? So, hey guys, I appreciate you being here. As I always say, we're here Thursdays, 4:30 p.m. Central. We're also here Saturdays at 11 a.m. Central. All right. The best person who's going to take care of the old you that needs to eat, the old you that needs to pay rent, the old you that needs utilities, the best person who's going to take care of that old you is the young you. All right, guys, take care of yourself and take care of other people. Until the next live or until the next video, peace.